Hey guys, my name is Michael and I do real estate test prep for the state of Washington. But today I'm just going to focus on the finance portion, which the exam itself has 10 questions on, so let's go over 10 questions. If you're curious, I'm going to do the questions from the Prep Agent website and go over the questions and the answers and explanations of the answers. Okay, let's get started. Question 1. The lender is required under RESPA and TRID to provide a detailed loan estimate disclosure at the time of loan application within 3 business days, but no later than 7 days before closing to what? A, the seller. B, neither the buyer or the seller. C, both buyer and seller. Or D, the buyer. So the answer is the buyer, and the explanation they give is when a home buyer applies for a home loan, the TILA-RESPA integrated disclosure rule requires the lender to provide a loan estimate to the buyer within 3 days of the receipt of the loan application, and all revisions have to be delivered at least 7 days before closing. The loan estimate details the loan terms, mortgage payments, cost of closing, and the costs and fees related to the loan, many of which cannot change. Okay, so next question. An owner of a trailer park wants to sell his business and real estate so that he can purchase a bed and breakfast, but the tax on the capital gain would be prohibitive. One alternative that would allow the owner to make a change in lifestyle while avoiding payment on capital gains tax is to what? A, sell and then buy a foreign property. B, sell and then buy a larger, more expensive venture. C, do an arm's length swap with a friend. Or D, structure a like-kind exchange involving a similar property. Answer is D, structure a like-kind exchange involving a similar property. Explanation: a Section 31 exchange known as a like-kind exchange allows the owner to trade the property for a similar one. This is only applicable to investment properties and is not effective in the purchase of foreign real estate. Okay, next question. What is the difference between MIP and PMI? A, PMI is an older form of mortgage insurance. B, MIP is required only on VA mortgages. C, there's no difference. Or D, PMI insures conventional mortgages and MIP insures FHA loans. Answer is D. PMI insures conventional mortgages and MIP insures FHA loans. Explanation: the MIP, or mortgage insurance premium, is charged on FHA loans. PMI, or private mortgage insurance, applies only to conventional mortgages. Okay, next question. During a period of high inflation, the Federal Reserve Board can limit to some degree the expansion of currency by what? A, decreasing reserve requirements of member banks. B, decreasing the income tax. C, increasing the income tax. Or D, increasing reserve requirements of member banks. Answer is D, increasing reserve requirements of member banks. Explanation: during a period of high inflation, the Federal Reserve Board can limit to some degree the expansion of currency by increasing reserve requirements of member banks. This forces member banks to keep more cash on hand, so there are less available funds to be lent out, reducing the amount of money in circulation. Okay, halfway there. Question: a purchaser negotiates a mortgage loan in which she will make equal monthly payments over a period of 30 years, with the balance of the loan being zero at the end of the term. The purchaser has negotiated what? A, straight loan. B, balloon mortgage. C, fully amortized loan. Or D, partially amortized loan. And the answer is C, fully amortized loan. Explanation. A loan with equal constant payments which result in a zero balance at the end of the term is a fully amortized loan. A balloon loan is one type of partially amortized loan. In a partially amortized loan, the principal and interest payments do not pay off the entire loan. A balance remains and is due at the end of the term. A straight mortgage is a loan that requires a periodic interest payments to the lender, but nothing is applied to the principal balance. A construction loan is a type of straight loan in which the borrower receives money and draws and makes periodic payments of interest on those draws. Okay, so question. If an individual gives his property a security for a debt but does not give up possession, he has what? A, conveyed the property. B, hypothecated the property. C, converted his fee simple title to equitable title. Or D, devised the property. Answer is hypothecated the property. Explanation. If an individual gives up his property as security for a debt but does not give up possession, he is hypothecated. Okay, so next question. Most lenders, when they are deciding whether or not to make a proposed real estate loan, try to minimize what? A, the borrower's difficulty which may arise in the future, such as divorce or death. B, chance of a substandard loan becoming part of their portfolio. C, overall net yield. Or D, loan to value ratio. And the answer is B, chance of a substandard loan becoming part of their portfolio. Explanation. Substandard loans in a term for borrowers with a bad credit history, so they are high risk, therefore lenders try to minimize them. Okay, so question. The discount points charged by lender on a federal VA or FHA loan are a percentage of the what? A, down payment. B, sales price. C, appraised price. Or D, loan amount. And the answer is loan amount, D. Explanation. Discount points are one-time charges equal to 1% of the loan amount for each point charged. Okay, so question. Which statement best describes a VA loan? A, a variable adjusted rate mortgage that adjusts monthly to reflect the prevailing legal interest rate. B, a loan insured by the Department of Housing and Urban Development, which offers low-income people the chance to become a homeowner. C, a loan funded through the Department of Veteran Affairs for qualified veterans on approved properties. Or D, a loan backed by the U.S. Department of Veteran Affairs, which offers veterans and service personnel the opportunity to buy a home with favorable terms, often with no down payment requirement. So the answer for this is D, a loan backed by the U.S. Department of Veteran Affairs, which offers veterans and service personnel the opportunity to buy a home with favorable terms, often with no down payment required. Explanation. A VA loan, Veteran Affairs, loan is one that is guaranteed by the Department of Veteran Affairs. Yeah. Although loans are funded through a private lender, this type of loan is available to eligible veterans and service personnel wishing to buy approved properties and offers reasonable terms such as the option to buy with no down payment. Okay, and last but not least, question 10. What is the court order called which directs the sheriff to sell real property to satisfy a judgment? A, foreclosure. B, a writ of execution. C, a writ of attachment. Or D, security agreement. And the answer is B, writ of execution. Explanation. A writ of execution is a court order to put in force a judgment of possession obtained by a plaintiff from a court. When issuing a writ of execution, a court typically will order a sheriff or other similar official to take possession of property owned by a judgment debtor. Okay, so guys, that's it for me. Those are 10 questions for the finance portion of the real estate license exam, brought to you by the Prep Agent website. So shout out to them. Let me know if you have any questions or you want me to keep going and do some more finance questions or other portions. And don't forget, if you like this video, like and subscribe, tell your friends and family. Let's get studying and pass this stupid exam and move on with our lives. It's gonna be great. We've got this. I believe in you. Have a great day.